Good morning to you both. Jonathan, I'll start with you. I mean, perhaps not surprising to see the market down slightly this morning. It does feel like there are three key pillars that we've been talking about for quite some time that are moving equities, and that is earnings, that is geopolitics, and that is the Fed, and the intersection of all three. How are you gaming those out, and where do you expect major averages to go from here?
As much as right now we're feeling an awful lot of tension in markets, we're pretty optimistic. We just put a note out which just highlighted that corporate profits, the projections for 2022 are up something like 2.5% now compared to the beginning of the year, even though the market's off by 9% or so. So that side looks pretty good. And as far as the Fed is concerned, if given the inflation, if they didn't acknowledge the situation, and if they didn't talk about getting off of a zero interest rate, then I think we'd have something to worry about much more than the fact that the Fed is looking to move interest rates towards 2% over the next couple of years.
Nancy, I mean, what's so key about this Russia-Ukraine situation is the fact that it comes in the midst of what was already a perfect storm for inflation, for example, and a Fed that is moving to tighten. And the question, of course, being for the markets, tighten how aggressively? What does this ratcheting geopolitical situation mean for Fed policy? I guess, how is the bond market and how are some of these volatility ETFs such as yours factoring this in? How does that play out?
Well, I think, Morgan, you said it well. The clock is ticking. We have a lot of unknowns out there, whether it's the geopolitical situation or the Fed's policy itself. I think the big unknown is really the balance sheet and whether the Fed gets more active and more vocal after the March hike with balance sheet reduction. Right now, there are so many hikes that have been priced in already into the market, and we still have inflation prints. So I think this is a time that the Fed is going to have to pivot and do more, and it's probably not with just rate hikes.
Jonathan, asset managers typically have a tough time sort of figuring out the implications of geopolitical movements like the ones that we're watching right now. So what does history tell us, if anything, in terms of how we should approach what's going on between Ukraine and Russia?
Yeah, I think that you hit upon it. When I've been talking to managers, whether they're at mutual fund shops or at hedge funds, what they all basically say is just focus on the fundamentals, that this is going to be, likely the source of some near-term volatility. But over the long run, the fundamentals are going to win out. So I'm not seeing an obsession on these. I will tell you that's not the case with folks who are, engaged in energy markets or those exposures, because obviously it's a bit more impactful there. But in terms of broad-based earnings or the broad-based economy, we just saw recently, these numbers, these PMI numbers came out super strong. But we are going to see, some slightly stronger inflation prints distorted by oil prices. But I don't think the long-term story is any different.
Nancy, although a lot has been priced in, a lot of people are drawing comparisons to the recent S&P action to December of 18, when you did have a Fed that was trying to tighten into a slowdown. Some have done some work that says that would imply an S&P 3 handle sometime in March. Now, these analogs don't always work, but I wonder, have you been impressed with the way in which history is rhyming here?
Well, I do think the market has to keep in mind that the Fed is just talking right now. They haven't actually done anything. They're tapering. They're still buying bonds. QE is still going on. We haven't actually started the quantitative tightening. And if you look back into history, December 2018, Chairman Powell was still at the helm of the Fed. We obviously had a different president at that point, but the rates market had priced in 3 hikes in 2019, and what actually happened is the Fed cut rates 3 times. So I do think it's an interesting opportunity with all the geopolitical issues going on to actually look at the Fed hawkish guidance has already moved the market. So you have 7.5 rate hikes already priced in. And I think it's a unique opportunity for strategies that can benefit from the steepening of the yield curve, whether that's lower front-dated yields or higher long-dated yields, which would normalize in a more risk-on environment.